As a basic rule of thumb, I like to think about it as if you see a ETF with a yield or a dividend stock with a yield above, say, the long-term return of the S&P 500, about 10% a year, might be an idea to look further because the yield is artificially inflated, but it could be cut very soon.
Hi, everybody, and welcome back to ETF Market Insights. I'm your host today, Zayla Saunders, and I am joined by Tony Dong. Before we get into it, as always, a quick reminder, we're not providing any investment advice or recommendations. Today is all about information and education for Canadian DIY investors. Tony, so happy to have you here with us.
It's always nice to be back on this show.
Tony, tell us a little bit about who you are, what you do.
Yeah, sure. So I primarily run ETFportfolioblueprint.com. It's my own website where we go over ETFs on the Canadian and the US side for retail investors and advisors. On the US side, I'm the lead analyst for ETF Central, which is a collaboration between Track Insight, a data platform, and the New York Stock Exchange. I've written for various publications. On the Canadian side, you may be familiar with Money Sense, but there's more like US News and World Report, The Street, Benzinga, 24/7 Wall Street, and USA Today. And I live in BC, out in the rural, in the bush, and I'm a homesteader. So I've got a bunch of chickens and goats, and I just do my own thing there.
And I'm so grateful for all the goat pictures you're constantly sending me and updates with your farm.
They're very cute.
What are their names? Chestnut?
Buttercup, Peanut, and Cookie. So I just plan to keep naming them after various pastries.
Tony, let's kick things off. Why is dividend investing so important with Canadians?
So there's two reasons here. The first one is that Canadians have a lot of tax sheltered account room. And that's one thing that consistently comes up in my conversation with Canadian and US investors. On the US side, they don't really have the flexibility we do with a tax-free savings account. So while a lot of investors use a TFSA for long-term capital appreciation, some investors will use it for income because the contributions and the withdrawal rules are relatively lenient compared to, say, a Roth IRA. The other reason is that certain dividend ETFs also provide decently tax-efficient income, and that a majority of the distributions can be eligible Canadian dividends, which receive a gross up from a tax credit and are thus taxed at more favorable rates compared to, say, interest income from a GIC.
So we know Canadians love dividend investing. You're talking about more of the tax benefits here, but where are you seeing most clients implement dividend ETFs or dividend strategies in their portfolios? Tax efficiency? Is it volatility control? Like what do you see mostly people using these for?
By far and large, it's income, and it really is tax efficient income. So I know a lot of people gloss over the taxes, but it's a big reason why people go with Canadian dividends over, say, US ones. But the income component is very important here because we know that mathematically on the day of the dividend being eligible for that dividend called the ex-dividend date, the stock price will drop by the amount paid, all else being equal. So it's not free money. But the psychological benefit of that, especially for someone in a decumulation phase, is being able to stay hands-off and realize that income. Because we know a lot of investors have this mental accounting bias where they don't want to sell shares. It feels like you're depleting principal, but getting dividends feels like income. And I'm of the view that if that helps investors stay the course, it can be beneficial. Just keep that in mind when you look at it. Total return is ultimately all that matters.
Yeah, hot topic, especially lately. I find I'm having a lot of discussions around total return. I know some income investors look past that sometimes. So Tony, what would you say to people maybe who are getting caught in the income trap or the high yield trap? Like, how do you manage a dividend portfolio appropriately and know what's an appropriate amount of yield?
I look at it this way. If I'm not withdrawing from my portfolio, income isn't really the priority here. If I'm getting a 7% yield or something and all I'm doing is reinvesting it back in there, there's no difference than if the share price increased 7%. I like to use the example of Berkshire Hathaway, which has never paid a dividend in its life. And you look at the Class A, you look at the Class A shares, they're at over $700,000 a share without a single dividend paid. Dividends are taxable events. You look at them as a forced sale. A company pays you a dividend when it can no longer reinvest that money internally above its cost of capital. They don't think it's favorable to buy back shares, and they don't want to use it to acquire the company. So that's the company management saying, hey, we don't know what to do with this money. We've grown all we can. We're a mature business. Here you go. Right? So that's technically what a dividend is.
Controversial topic, especially given with how much tech is ripping and not paying dividends. But let's talk about the Canadian dividend scene in Canada, particularly the ETF portfolios. What would you say the predominant construction of dividend ETF or portfolios are in Canada here today?
The average Canadian dividend strategy, whether index or active base, is going to take the existing biases you find in broad Canadian indices like the S&P TSX composite
Yeah.
and concentrate them even more. So what we tend to see is an overweight to financials and energy. In financials particularly, you have the big six banks, including BMO, and you have the life insurance companies such as Sun Life and Manulife. For energy, you have your upstream operators, so stuff like Suncor and Canadian Natural Resources, and also your midstream infrastructure like Enbridge and TC. All of these pay high dividends, and because they have more or less a management mandate to do so. It's not explicit, but the culture over the last 150 years or so has been okay. We're going to return stuff to their shareholders. We're going to be conservative with that. And investors have kind of grown to expect that. So it's a bit of a self reinforcing loop. However, energy and financials are both highly cyclical industries. And you
Yeah.
look at financials here, a bit of a boom or bust mechanic, especially around recessions. Energy, while they can offer you protection during inflation like 2022, if you remember when oil futures went negative during the COVID-19 crash, energy
Yeah. Yeah.
stocks really ate it. So if you are relying on dividends from these, irrespective of how many years a company might have paid that dividend, right, you're going to run into a lot of cyclical business risk there. And that's the case for diversifying through an ETF if you are a dividend investor.
Yeah, and I know you talked, Tony, about the tax benefits of having a Canadian dividend portfolio, but let's talk about maybe you talked about the concentration risk around having that Canadian centric dividend paying portfolio. Let's talk about the benefits of maybe broadening out and having like an IMI or an all world approach.
Yeah, so it's not just Canadian companies that pay dividends. And while they may be tax efficient because of the whole eligible and gross up requirement, Canadian stocks by market cap weight only account for about 3% of the global equity market. So if you're only focused on Canada, you're ignoring a big opportunity set out there. And if you think about how a lot of Canadians will already have Canadian income from a job, they may have a house here. Your net worth is probably already tied to Canada a lot. And that's the other argument against it. So being able to use the IMI approach, which from MSCI stands for Investable Market Index, broadens your opportunity set globally and also to not just large, but also mid and small cap stocks, because it's not just the blue chips that pay dividends. A lot of smaller companies do as well.
Yeah, this is a great segue, Tony. So let's talk about the ETF that BMO recently launched, ZDIV. It's the BMO MSCI Canada IMI High Dividend Yield Index. Can you speak to a little bit of the methodology behind that and why someone might want to consider using that MSCI methodology approach versus maybe a traditional active managed dividend portfolio or ETF?
Yeah, so transparency is the big one. When you go with a large index provider like MSCI, you're able to really drill down into how the index selects and weights its stocks. And that can be found on the index website. You can download their methodology document, and you, as an investor, should be looking at these things to see exactly how the stocks are being picked. Because when you buy an index ETF, you are buying the benchmark. So you have to have confidence in that and knowledge of how it works. The MSCI high dividend indices are a subset of what we call factor indexes. So MSCI, in addition to dividends, they also have factors like momentum, low volatility, and quality, to name a few. It's a roundabout way of selecting stocks that have certain characteristics. And when you depart from market cap weighting and do this, there are times where these factors will outperform, and there's times where they're underperform. So you need to be aware of this. Now, if we go specifically to ZDIV, we see that the MSCI methodology it tracks uses a hybrid approach. So it's not one dimensional.
Yeah.
One of the main weaknesses with some dividend ETFs is that they are very, very like just myopic. So
Yeah.
they might just screen for high yields historically, or they might just say, okay, we want something to have 6, 7, 8 years of consecutive dividend growth. ZDIV's benchmark is much more selective than that. So in addition to looking for above average dividend yields, there's a focus on liquidity and quality screens. After all, you're owning stocks. You want to make sure that these companies are profitable, even if they are paying a dividend, that they're easily traded and they're in the universe where you can transact easily. And then there is a bit of a momentum screen that looks at 12-month past performance because you want to avoid stocks with deteriorating fundamentals. We call these falling knives. In the context of dividend investing, that could precede a dividend cut or pause, which is a universally bad event. The last time it happened in Canada was with telecom BCE. So you saw a 12% dividend yield that fell 50% the next day to 6%. And I think we might even see that with TELUS. Their debt's not good. But avoiding stuff like that is why ETFs can be so useful.
Yeah, and I think it's, we've in our world, we have a lot of discussions around covered calls and high yield, but I think this dividend conversation has been a little quiet lately. But it's the same thing, right? That yield trap that we're talking about. Just because there's a 20% dividend yield, the share price may have fallen, and that would have changed the ratio for the dividend yield. So high yield doesn't always mean profitability and total return over the long term.
So the other thing investors looking at individual dividend stocks have to be careful are special situations with what we call pass-through entities. So these are things like master limited partnerships, real estate investment trusts, and business development companies that are required by law to pay out like a big portion of their earnings, maybe around 90% or so, in order to avoid corporate level taxes. That can lead to artificially high yields. As a basic rule of thumb, I like to think about it as if you see a ETF with a yield or a dividend stock with a yield above, say, the long-term return of the S&P 500, about 10% a year, might be an idea to look further because it could either be one of these pass-through entities, or like you said, the stock price, the denominator, could have fallen so much that
Yeah.
the yield is artificially inflated, but it could be cut very soon.
So, Tony, let's talk about positioning ZDIV in a portfolio for investors. How might they consider positioning in their portfolio if they haven't looked at this ETF already?
The thing is, you can look at ZDIV as a income tilt, and that's perfectly valid because of what it does. But remember what I talked about dividends being a factor themselves? Well, if you think about it, when you screen for companies that pay a higher yield, all else being equal means the share price is lower. While it's not a perfect approximation of the value factor, in practice, we see that dividend strategies, especially high yield ones, tend to provide a decent approximation of the value factor. Similarly goes for stocks or ETFs that screen for historical dividend growth and for sustainable payout ratios. That can be a proxy for the quality factor. So you're focused on companies with wide margins, high return on equity, and robust balance sheets to be able to grow and pay that dividend. So I think for investors is broaden your mindset a bit when it comes to dividend ETFs for your toolbox. Yeah, they're useful for income, but you can find that a lot of these are much more affordable than, say, a brand name quality or value factor ETF might be while delivering comparable exposures.
I'm so glad you mentioned that. Let's talk fees on this particular ETF.
Yeah, so fees reduce your returns, they reduce your yields. Nobody likes them, but that's the convenience you pay. But as an investor, you have choices and you can look around. And in the Canadian dividend ETF universe, I remember back in way at the start of the century in 2000, paying 66 basis points for a dividend ETF was considered pretty affordable.
Yeah.
That's way too expensive now. With something like ZDIV, you're looking at a 0.9 management fee.
Yeah.
That's very affordable.
One of the
And
lowest in Canada, I think.
one of the
If
lowest
not
in
the
Canada.
lowest. Yeah.
Yeah, and I think that ties into a broader trend we're going to see across the Canadian ETF industry, which is fee compression, right? Providers are looking at these old categories that are highly popular and realizing that the incumbents have not meaningfully reduced their fees. And by coming in with new solutions that track new benchmarks at lower fees, it creates competition. And as we know, that results in better outcomes for investors.
Fabulous. So, Tony, if we're going to leave listeners today with one thing, what would you say to them?
Don't focus on yield. It's always about total return potential after all. There's no difference in getting $1 in dividends and $9 in capital appreciation versus $9 in dividends and $1 in capital appreciation. Also, keep in mind that every dividend you receive, whether monthly or quarterly, is a taxable event unless you hold in a registered account. So that's something that a lot of people, when they just look at the on paper returns of these ETFs, fail to realize. There is going to be tax drag. And also think about what your objectives are, right? If you're focused, if you are not going to be retiring and needing income in the next 10 years, maybe think hard about whether you really need a high yield ETF or maybe you want something that's more focused towards that total return compounding. But regardless of how you decide to position for dividends, by staying diversified and keeping fees low, that gives you two really good bases to set yourself up for success.
Tony, I want to go back to when we were talking about the differentiation between different ETFs. You mentioned that some have more heavy concentration in financials and energy. Let's talk about ZDIV a little bit more and how that ETF is different from some of the other Canadian dividend ETFs.
Yeah, so ZDIV's holdings still remain fairly curated when it comes to dividend strategy. We're only looking at 50 here. But what we tend to find is that instead of, say, more over 50% weight to financials, it's significantly less. Right now, I'm seeing about 30% of financials and 32% energy. It's still heavy in there for sure, but that's unavoidable if you're going to be investing in the Canadian market. What we find is that when you market cap weight any strategy without limitations on what a certain company can be, in the Canadian universe, it can result in outsized allocations to one or two stocks. For example, one of the most popular dividend ETFs in the Canadian market, I'm not going to name any names, has over 15% of his holdings in one bank stock.
Yeah.
And as amazing as that one bank stock is, when you have that kinds of concentration ETF, you got to ask yourself, is my thesis on the overall portfolio providing me dividends over time, or just on one company being able to maintain its streak? And again, no matter how good that company is, I'll make an exception for Berkshire Hathaway. I don't want to have that much in there, right?
Your
And
favorite
by
stock of all time.
I love Berkshire. It's just
I
such a great
know. You
compounder.
got your t-shirt on. Yeah, you're big fan.
But to bring it back to ZDIV here, I see the methodology has, by tampering down that energy and financials, you're able to target more dividend-paying sectors in the Canadian universe. So that a big part of that is utilities, right? If you think about these low beta stocks, inelastic essential services, steady rate increases that are usually set by regulatory standards, and against that heavy capex that they're doing for the AI, they're still returning you cash as a shareholder, which is going to be different from a lot of the hyperscalers in tech we see today. You got communication services like Bell, Rogers, and Telus. I know those have been out of favor recently, but they've been very popular for dividends, and even some consumer discretionary too. Canada isn't just railways and financials and banks and pipelines, right?
Retail.
We have a lot. We have a lot more than that. And it's important for a dividend strategy to capture these, because you never know where tomorrow's dividend leaders might come from.
Yeah.
Right. Companies that increase payouts and return shareholders. The past has a precedent here, but I think investing should be forward looking as much as possible.
Absolutely. Well, Tony, it was such a pleasure having you on the show today. Thank you so much for joining us.
It was my pleasure. Happy to be here anytime.
For everybody watching, we want to know, are you a dividend investor? Are you investing in dividend ETFs? Comment below and let us know. Thanks, and bye for now.